Hello, I'm John Kreitler. Welcome to This Week in the Markets. While we wait for the Federal Reserve meeting and decision next week, stock market indexes pull back into correction territory, intraday over 10% from its all-time high for the NASDAQ, the S&P 500, and the Dow Jones Industrial Average. Furthermore, from a technical basis, all three indexes are below the 200-day moving average. The uncertainty in terms of tariffs, government policy and such, as well as the Federal Reserve, has weighed on the stock market. But one thing I'm looking at right now is the bond market, the credit spreads. More about credit spreads in the next Macro Minute segment. Credit spreads, suffice to say here, is the compensation from a U.S. Treasury to investment-grade corporate bond to a high-yield corporate bond. Credit spreads have been very narrow since the pandemic, meaning that the bond market really thought that inflation was going to come down and that there's really no risk of a recession over the last few years. Narrow credit spreads, the bond market thinks things are relatively stable. Right now, the bond market still has credit spreads at a historical low, very narrow. There's been a slight widening over the last few weeks. That is something to consider and to look at. But right now, the bond market sees things stable and the economy to get through all we're going through right now. It's the bond market many times that's the signal and not the stock market. I'm John Kreitler. This was This Week in the Markets. Have a great week.